panel discussion, which is, well, financing. And that's the major part when it comes to infrastructure, right? How is it that we can bridge the funding gap? How is it that we can talk about financing infrastructure? How is it that we can be future ready and creating a better roadmap? How is it that we can actually bring about and shorten the gap there? Taking these discussions forward and moderating this segment will be Mr. Vishal Gupta, Executive Director, Deloitte India. Please do put your hands together for him as he steps forward. We'll also request all of you all to please take a seat as per the names of the backdrop. May I also welcome our esteemed panelists. It's a pleasure to have amongst us Mr. Shiva Rajaraman, Chief Executive Officer, NIIF Infrastructure Finance Limited. A round of applause for him. My audience, I'd love some more energy, please. Let's hear it up for Dr. Nalin Jagdish Kumar Gupta, Managing Director, J. Kumar Infra Projects. We also have with us Mr. Samuel Jabraj, Deputy Managing Director, National Bank for Financing, Infrastructure and Development. And let me welcome Professor Anil Kashyap, President and Chancellor, Nikmar University. A delight to have him amongst us all. Once again, a humble reminder to all our guests to please be active on your social media platforms. May I once again request the presence of all our speakers on stage, please? Mr. Shiva Rajaraman, Dr. Nalin Jagdish Kumar Gupta, Mr. Samuel Jabraj, Professor Anil Kashyap, and of course, the session will be moderated by Mr. Vishal Gupta. Mr. Samuel Devraj will be joining us in the next minute or so. Till then, let us kickstart the discussion. Mr. Gupta, all yours.
So good morning. As we have seen, soft infrastructure, data centers. Now, hard infrastructure is the backbone. And as we all are aware that India is looking for $5 trillion economy and $1.4 trillion need to be invested in NIIP, in infrastructure, hard infrastructure. And when we look at the financing part of it, most of it comes from debt. If we typically look at the debt equity segment, 70% comes from the debt. I'll begin my question with Shiva. And since NIIF is working and lending heavily in infrastructure, so how do we see typically the debt structuring or debt going in the next 1 decade?
Just to thank the organizers for inviting me. To give a brief of what my organization represents. NIIF was created by the Government of India in Mr. Arun Jaitley's budget speech in 2016 as a set of entities, both equity funds and debt funds. So catering to both the requirements of infrastructure in India. And it was set up as a public-private partnership with government holding being 49% or lower, and with international institutions taking up the balance 51% in terms of ownership. The board is also both a public-private partnership. To get to your question, what will we see in the next 10 years? Different types of asset classes on one side, different types of sources of funding on the other side, and third, different types of instruments through which this funding will come. So traditionally, at least in India, we've had banks and NBFCs funding infrastructure. In the recent past, the new institutions like NABFID and NBFCs funding has been higher than that of banks. The point here is that the new asset classes will require different kinds of institutions to fund. Pension funds, provident funds, insurance companies in one category. These are the longer term investors. Banks, NBFCs are the medium term kind of investors. The third category of investors that we will likely see in the next 10 years include wealth funds, family offices. For example, Azim Premji Foundation has over 100,000 crores to invest. Poonawalla Foundation was cash rich even before COVID. I think after COVID, given the requirement of vaccines, etc., it is even more cash rich. There are at least 20 wealth institutions in the country which can provide funding. Today, that money does not come to infrastructure. There are ways in which, through certain types of instruments, through certain types of incentives from the government, this money can be channelized into infrastructure. Typically, in a particular year, to give the numbers, out of our $4 trillion GDP, around 20% is public-private sector or private sector. Out of that, around 5% goes into infrastructure. Out of that, 70% is debt, and out of that, rupee debt constitutes 80%. The total of this is approximately 200,000 crore going to private sector projects in India every year, increasing at the rate of 7 to 8% per annum. So the kind of instruments would be, it has already started, green bonds, social bonds, new category called catastrophe bonds. These categories have already started getting popularized in Europe and the US. I think within a year or two, these categories will be available in India. What are catastrophe bonds, for example? These are bonds in which several philanthropic institutions, along with government institutions and private investors, invest. Why philanthropic and government institutions? Because these institutions either subsidize or provide concessional rates, and in turn, the private sector investor gets a higher return. It satisfies the requirement of all the classes. There has been a divergence between historic experiences versus what we are seeing today in terms of actual delivery, in terms of infrastructure projects. For example, wind patterns in the past can no longer be used to predict for the future. We are in the process of working with one of India's leading insurance companies to develop an insurance product that can take care of wind resource risk and wind availability risk in an affordable manner. Also working in terms of providing flexible coupon bonds, which are combined with the green character of bonds, so that flexi coupon can take care of reducing the probability of default for these bonds and therefore making them significantly cheaper. Thank you.
Thank you. And let's move to the developer side or the contractor side, wherein not only private investment but EPC mode is also prominent nowadays. And if we look at the data, more than 50% of the projects in infrastructure are being implemented in either EPC mode or item rate contract mode. So when it comes to financing of it, we see this as a working capital or a short-term financing. As a developer or contractor, what kind of challenges you face when it comes to funding for the EPC projects?
Well, so I think I want to mention here that the EPC projects, which is the government's total spending, you will find more than 60% of the spending is into the EPC sector. Again, if you talk about the 40% of the development sector as a PPP or BOT model as well, even there the actual EPC contractors comes into place, because it's not that most of the developers are executing the projects on their own. So the EPC contractors are again mandatory to be existing and surviving to take care of the growth and the GDP that the country is looking for. When you come to the financing part of it, the biggest challenge as of now for most of the infra companies that when we talk to our friends and partners in the industry, is the non-fund based limits. So when you come to non-fund based limits, almost 5 to 10%, most of the contracts have a requirement for 10% as the performance bank guarantee that needs to be submitted within a span of 30 days from the date of LOA. So, and if you don't submit it, your bank guarantees, the EMD money would be forfeited and stuff like that. So the window available of 30 days is so short that the consortium limits available within an organization does not is not so well sufficient to take care of the growing infrastructure and the new order inflows that most of the performing infra companies are seeing, and everybody are flooded with good size of orders, and every infra company in the EPC sector having the capability are growing at a good pace, I would say. So here, if the bank guarantee limits, which are even the bid bonds, your performance guarantees, your retention money, your mobilization advance bank guarantees, if this can be converted into surety bonds, which we are again with the help of Mr. Ajit ji, and we are already pursuing it at the CFI level, wherein we are putting this point to the various government bodies. So surety bonds, which surely takes care of the same, it plays the same part as it is as good as a bank guarantee. The only difference is bank guarantees are issued by banks and the surety bonds are issued by the insurance companies. So in that case, the cash flow and the working capital can be taken care of, and the infra companies can overcome the challenges of arranging for the bid bonds or performance or mobilization advance bank guarantees in a much better way is what I feel. And also this 10%, if it can be reduced to 2 or 3%, because government to recover any defaulting contractor, which is not even like 6 to 7% of the total order book, if you see, there are not more than 5 to 7% defaults that happens in the entire country. So because of that, it need not be made 10% and it can be brought down to 2 or 3%, because in case of any default, government companies can very well cover this amount from any other government institution by simply writing a mail to them.
So one part is your initial bank guarantees. Right from the conceptualization stage of an EPC project or a PPP project, do you see any challenge in project preparation stage, particularly for your EPC projects as a company, because you are on the other side of the table?
Well, so I think I would like to make it in a very softer way, but I would like to mention this point that if you take it as NHAI or MSRDC, there are some organizations which has made it as a choice to the developer or to the contractor to accept the date of start if 85 to 90% of the job site is ready. So I would say if this becomes as a trend, because in most of the EPC contracts, you don't have this choice. And when you talk about the land acquisition issues, the various utility mapping issues, your tree cutting permissions, there are PAP rehabilitations. This process starts after the project is awarded. So when you talk about a common man, we are like doing a sizable job even in the metro sector, whether it comes to elevated or underground. People are willing to take the inconvenience of traffic blockage, working at the night hours, because most of the metro or flyover works happens when people are sleeping. We start the work of erection, launching is what we have to do at night time because of the traffic issues. People are willing to accept this inconvenience, but if this project preparation is planned in a proper way, and the land acquisition, your utility mapping, coordination with various authorities, tree cutting permissions, if you get it in place, the projects which are seeing cost and time overrun and eventually getting a bad hit on the bottom lines of the performing infra companies can be really got controlled. But in most of the EPC contract, as I've said, you don't have a choice. There is a pressure on the department to issue the LOA. Once the LOA is issued, we contractors, we don't have the choice. And the the cost of like even if you talk of overheads, your major cost lies in the key personnel, which is not even 20% of the total staff that is deployed on a respective project. 80% people draw less than 50% of the project cost salary. But those 20% need to be there on day one. and the project is not really available for the contractor to execute, whether it is a developer, a PPP project or EPC project. So if these things are controlled and they have made the entire site available at least to the tune of 80%, the time, cost overruns and the inconvenience to public, everything can be addressed is what is my feeling.
Yeah, that's very correct. And when we talk about infrastructure, the sustainability and resilience has also taken the forefront. It has always been at the forefront, but now it has formally taken up the shape. And in this new era of development sustainably and the infrastructure to be resilient, there are various financing mechanisms. So, Mr. Samuel, is there any thought about or new innovations in the products for sustainable and resilient financing of infrastructure? So, what are your thoughts on what can be done and what is being done nowadays?
Yeah, thank you, Vishal. Well, before I answer your question on what we do, let me first answer who we are, because we are the newest kid on the block. We have just completed our first year of full operations. NABFID was created by an act of parliament. We were created through the budget announcement of 2021. We were operationalized in December 22, the last week of, so the first full year of operations was March 24. But since the government gave us initial capital of 25,000 crore in a single check, we were able to do large size infra lending long-term business. So in the very first year, we have done business of about 1 lakh crore. Only infra, because as per mandate, we can do only infra long-term financing. Within this, what we have done is we do really long-term. If concession agreement is for 25 years, we can theoretically go up to 21.5 years. So these are mainly from the transportation and energy sector, mainly roads and renewable energy. Of course, we have done the other sectors like city gas distribution, data centers, ropeways, warehouses, so many other sectors. But more than 70% of our business as on date comes from transportation and energy. Since you talked about resilient or sustainable infra financing, of course, as I said, almost 30-35% of our book today is in the green segment. But what more can be done to make it sustainable? Actually, in the Act itself, we have been given special provisions that the Government of India guarantee, if given to NABFID for raising international resources, can come at a concessional guarantee commission of 0.1%. So that makes us much cheaper in order to access international funds which are available for sustainable lending within the country. Also, the Act also provides that the hedging cost can be absorbed by the government on a selective basis if it is a national interest. For instance, just last week, we have a cabinet has approved the policy for offshore wind. Offshore wind has come with a VGF funding of approximately about 6.5-7 crore per megawatt. Viability gap financing has been announced. If this has to be scaled up, then we will require blended financing concessional, because today cost per megawatt of an offshore project is 20 crore vis-a-vis, let's say, an onshore project of 7.5 crore. So it is not viable without a concessional financing or upfront VGF. If that is required, then NABFID can be used as an instrument to raise these overseas funding, blend it and give it to these projects. Green hydrogen could be another case. So these are sectors of strategic importance for energy security and making it sustainable, where NABFID could play a role in financing such projects.
Okay. And when it comes to private segment, how can we make it more attractive for private players? Is there any thought on that?
As we all know, the risks in an infrastructure project mainly comes from the concession agreement itself. So the more ambiguity there is built into the concession agreement, the more disputes, arbitrations, delays, so on and so forth. So to a large extent, we will have to tackle these concession agreements itself. And we are happy to note that there is change happening even within the government on this side. For instance, the new model concession agreement for BOT toll projects, which were notified just before the election code of conduct came into place, there was a wide-scale consultation, both I'm sure with developers, with contractors, and with the banks in particular. And to a large extent, our suggestions have been taken into account. We were one of the few financiers who were consulted. So to some of the concerns what we had because of our past bad experiences in financing BOT toll projects, to a large extent have been taken care of in this. Also, if we have to mitigate some of these risks, actually today, these are all fixed price contracts. Let's say a solar power project has a 25-year power purchase agreement at a fixed tariff of 2.8 rupees. But most of the projects are funded by floating rate interests, MCLR linked or whatever linked loans. What has happened in the last 2 years when interest rates went up by 200 basis points, equity returns have been completely wiped off. Luckily, debt servicing has not come under strain and we have not seen any NPAs. Debt is getting serviced, equity returns have got wiped off. This is not the way infrastructure needs to be financed. And if you see many of these long-term financing, because commercial banks also finance long-term, which is not suitable for their asset liability management, even if they are extending a 15-year, 20-year loan, they put a 7-year put call, 10-year put call. Now the refinancing risk is an unnecessary risk you are loading on the project itself, which is extraneous. The project can live with intrinsic risks which are built in the financing model, but extraneous risks to a large extent we should avoid. So we as NABFID, conscious of this fact, give a long-term loan. And when I say long-term loan, it is really long-term without any put call. We are also encourage our borrowers to borrow fixed rate and not be exposed. In a 15-year, 20-year loan, 2-3 cycles will come and go. So you will never be able to time the market, time the cycle. But it is best to borrow fixed term and peacefully, because the developers' concern should be only how to improve the efficiency of the project, how to improve the PLF or how to improve other efficiency parameters and not take a call on how interest rates will move. So this is one thing what we have been doing is really giving long-term and long-term fixed rates. Apart from this also, we are working on, for instance, if infrastructure projects ideally should move into the bond market, but they are still being financed by the bank loan or NBFC, IFC loan markets, which is ideally not, which shouldn't be the case if you look at the economy as a whole. What we have done, we have written to the Reserve Bank of India for allowing us to do partial credit enhancement. Most of these infrastructure projects get a rating of, let's say, an A or a BBB plus at the maximum. And insurance companies where real long-term fixed rate money is lying, they require, as per regulation, a AA rating. Then only they can invest in this project. So by doing a 20% partial credit enhancement, if NABFID were to absorb first loss of 20% on that project, and if a A-rated project can move to a AA, then pension funds. And today, as we speak, huge money is flowing into the pension and insurance funds. And there are not many avenues for them to deploy. So this is one bridge where we can play and take these projects to the insurance and pension funds, which have real long-term money.
Right.
One thing, if I could add, two things that we've recently done. One part is, of course, completely agree with him. 100% of the loans that we have provided or bond funding that we provided to projects is fixed rate, thereby eliminating the interest rate risk for the project. A developer, as Samuel has stated, needs to focus on his business, not worry whether RBI is going to increase rates or decrease rates. That's one point. The second point is we've done something probably on an experimental basis called disintermediation. So 20-year requirement, 20-year tenure requirement for a particular project. One part is, of course, we can directly provide 20-year funding, but disintermediation is important. You strip the bonds, strip structure of bonds. You strip it into 3-year, 5-year, 7-year, 10-year, 15-year, and 20-year. Who's the most efficient at providing funding, debt funding for 3 year, the mutual funds. Therefore, the step structure of 3 year is given to the mutual funds. Between 3 and 6 years, it is given to the family offices and wealth institutions. Between 6 and 12 years, it is given to pension funds, provident funds, and insurance companies. When I say pension funds or when I say provident funds, it is corporate provident funds. Every corporate has a provident fund. The larger the number of employees, the larger the provident fund, Wipro, Infosys, etc., etc. And the last component between 50 and 20 years is taken by institutions like us. So find out who's the best at providing cheapest price for that particular tenor and allocate the funding to them through a disintermediation process. This we have experimentally done for a medium-sized, when I say medium-sized, about 1,000 crores requirement project. We believe this can be expanded to a bigger spectrum and segment. Thank you. Thank you.
Yeah, thank you. And this is a very good and live example. Switching gear to Professor Anil, since you are looking at from academia side, research into the infrastructure financing, and so on. So, what do you think could be done in a different manner as an institute? And what could be the contribution from academia in this segment, particularly on infrastructure financing part and de-risking it?
Thank you. As you said, coming from an educational institute, a built environment university of the country, I would like to draw your attention to two aspects. One is the innovation and another is skilling. In terms of innovation, when we look at infrastructure as a project, and there are loads of ways how we can finance, we can innovatively, we can develop. There are various models in the market. But when we look at the theme of this session is on resilient infrastructure, we need to look beyond construction as well and how we run and operate those things. Vidya just has mentioned in the previous session about the heat, energy, sustainability of data centers. Likewise, there is an issue about decarbonization of the transport infrastructure. If we take some international examples, there has been alternative fuels infrastructure facility project in European Union where zero emission mobility project has invested almost 500 million euros in decarbonizing the transport sector, where lots of electric vehicle charging points, where a lot of research has gone into development of hydrogen refueling centers. And also, when we create infrastructure like airports, it is so energy intense. And European Union, particularly under this project, has invested into decarbonizing the airports by providing almost 63 airports been decarbonized by providing almost 25,000 electrical vehicle charging infrastructure and almost 200 hydrogen refueling facilities. And that takes a lot of innovation, that takes a lot of research into creating such kind of facilities. And if we look beyond that, we will be actually creating this resilient infrastructure, and there can be various ways and means how we can finance them. There can be all these models which we are talking about. There can be public private partnerships, there can be European in Europe there are grants, and leveraging the financial institution into this one is a model. There are green banks in European Green Bank, in Norwegian green funds are there. So all these mechanisms can pull together all these into these projects. To make that happen, skilling is also quite important. In the first panel, Mr. Gulabchand just mentioned about the skilling needs and requirement, and this today's news about L&T looking at almost 40 to 45,000 skilled professionals. This is something we need to address here in this kind of forum. And looking at the overall GDP of the country, almost now 3.5% of the GDP is invested into infrastructure development, whereas we need about 6 to 9%. And looking at the order books, we were discussing just on our side, chats. L&T order book, we are talking about 1.5 lakh crores. And if we add together, we need more than 3 L&Ts to be built. And if we multiply that skill gap here, we need more than 10 NICMAR universities to be here in the country. And that is the main important aspect, that in order to generate infrastructure, we need skilling, we need research, we need innovation, and the structuring of the project can happen based on the economic environment of the country. At one point in time, there have been various models floating from 2010 onwards, from PPP to EPC to HAM, and now we are doing hybrid. So all this thing can come at a later stage, but as a professor and a researcher into infrastructure financing, I think we can focus on the latter aspect of the infrastructure, maintenance, running, operations, etc. at all. I'll finish here, but I can take further, call on that.
Very interesting conversation. If we look at the resiliency and sustainability part in infrastructure, there are 2-3 elements. One is, can we get a cheaper loan or funding when the infrastructure built is sustainable and resilient? But how do we measure that? As a developer or contractor, and as research academia, or maybe as funding agency or debt agency, how do we measure that part, and what are the checks and balances we can have to kind of have better governance around this also? Because when we say green bonds, when we say resilient infrastructure being created, is it really resilient? How do we measure that, and how do we build our product around this ecosystem? Any thoughts around this?
I can start with that, if that's okay. This measurement is quite an important indicator, and where at various forums, nations pledge about the targets set for the decarbonization. And if we go by those targets and we honestly and religiously follow some of the path, that's where I'm talking about decarbonization of transport. Some countries have put in their target. Now the major polluter on our highways is the cargo transportation, the kind of heavy vehicles. There have been research and there have been projects which are really, up and running in terms of decarbonization of the transport sector, decarbonization of the heavy transport, and how we can do that. Those electric highways, alternative fuels, hydrogen, all those things can achieve those targets. And if we put on those targets on our somewhere roadmap, I guess that will be a good starting point. But I leave the finance and funding part onto the other panelist here. Thank you.
Life cycle cost is a very important concept. So if you buy something, for example, an AC or something, if you buy the cheapest AC, maybe 1-2 years it will last and then it will stop. You could invest more in equipment that lasts for a longer period of time, but will have less maintenance cost and less renewal costs over the period. So life cycle cost is one concept which is associated with this. The second point is, what is the meaning of the word resilience? When somebody falls ill and then recovers, how fast does he recover? How much is he able to withstand? That is the traditional meaning of resilience. In the climate concept, for example, in agriculture, you have something called drought resistant seeds. These are through genetic engineering, they have been formulated. Can they resist climate change or increasing number of droughts? That's important. In the context of infrastructure, for example, in some states in the US, Florida, for example, where floods are getting more and more frequent, they've started building bridges which are much taller, which are not impacted by floods. That is an example of resilient infrastructure, and of course, it will cost more. In the Netherlands, in the last 20 years, they have built what is called walls in the sea, which prevents a tsunami-like effect on their land and on in terms of housing. These are all small examples of resilient infrastructure. Even having battery storage provides a certain kind of energy security and resilience. So this is resilient infrastructure. To get into the financing side, would lenders or bond investors provide lower cost to resilient infrastructure? Yes. If the life cycle cost is calculated, the overall cost is going to be lower. If a proactive lender or a bond investor understands this, would be willing to provide a lower cost. Now, exactly how much and how would depend on the project, would depend on the geography, and it would also depend on statistics relating to whether floods are getting more frequent, or are there aberrations in wind patterns and availability, so on and so forth. Does that answer your question?
Let's hear from others as well on this aspect.
Yeah, well, so I would say that there needs to be a lot of seminars and such forums that needs to be conducted, because as we talk about the green energy or green environment, there are various codes which permit the use of fly ash, GGBS to have low carbon emission concrete. But most of the contracts, I would say, uh, almost like 50% of them, they do not permit use of such usage wherein the carbon emission can be controlled. We can have carbon credits generated, but the right platform where we can apply for this carbon credits, we can take some, we can sell this carbon credits as well outside the country, because I would say the Indian companies have gone way ahead in terms of research and development in the concrete sector as well, wherein we have gone for concretes without cement. Concrete is been made, self-curing concrete. So again, use of water is less. So such type of products are available, but more and more government awareness and the acceptability from the government side, if it is there, I think it can play a vital role. And also, I would say that, as you were mentioning, that you need around 10 L&Ts to be there. I would say that right now in the infrastructure segment, I don't want to name it, but in this room itself, there are companies who have the capability to become and match somewhere near to what L&T is doing. And high-speed railway is again one of the classic example where it was been told that only Japanese companies should be have to bid for these contracts, and if Indian companies need to go, we need to go with the Japanese company. But let me tell you the fact, it's not that easy for every infra company to get a joint venture from Japanese company, because there is limitation onto it. But then various players into our industry, we've all jointly we fought for it, that give us an opportunity. And bullet train is not something which the Indian companies cannot do. And therein there was an opportunity given, and I would say almost like 30% as compared to the international players who would have come and constructed these bullet trains in India is been done. So there is capability, there is lot of I would say craving that is there with the infra companies with lot of potential. And earlier times when I was a kid and when I was like, I joined the business in 1995. So that time it was been said that if you want to earn money, if you want to be a good engineer and make some good money, you need to travel abroad, you need to work outside. But let me tell you, we are paying more than 2 crore rupees package per annum to single individual in India. So there is lot of potential because of this increase in size of projects, complex nature of projects, and that these people are getting an opportunity. So I think if a good cohesive atmosphere is created for the infra companies, where they are taken as a partner and not a contractor, I think that would change the mindset. This change of mindset is very much important, to treat people as the partners, the contractors who are one of the key players. You dream, we achieve. It is like that. So give us an opportunity where things should be heard, arbitrations or disputes should be having a smooth mechanism where things are sorted out, instead of like a span of 5 years, 10 years, you keep fighting in various conciliations, in arbitrations and then court. And by then the capable infra companies are already dead. So I think it's a that sort of partnership and ownership thing has to be developed between the government and the contractor, I would say.
Any thoughts as research institution?
I think the concluding remark is all about how we create that kind of ecosystem where all these difficulties can be resolved in a sort of more efficient manner. But I think skilling to deal with certain kind of aspects and situation is also important, which institution need to build into their research as well as into their curriculum, where people are industry ready and they can actually take up some of the challenges right from the day one when they come out into their employment. Thank you.
While demand for money will always continue, I think we are short of time. Thank you very much, all the members, and over to you.
Thank you so very much. Let's hear a round of applause for our wonderful panelists out here. Each thought that you shared with us out here has been an insight down deeper. So thank you once again for sharing those experiences.